One of the biggest financial mistakes people are making right now will only become obvious in the next 5 years, when it's already too late to fix. You see, most people believe they're preparing for the future by simply saving or investing traditionally. But the reality is, they're unknowingly putting their money into assets that will lose massive value by 2030. We're entering a new era where what worked in the last decade will quietly stop working in the next. Technological disruption, currency shifts, inflation cycles, and government debt are changing how value moves in the world. And while 90% of people will keep following outdated financial advice and see their portfolios shrink, the top 10% are already repositioning their money into new generation assets that will explode in value. In this video, we'll uncover the 2030 asset mistake most investors are making and show you how to fix it right now before the next major wealth shift happens. The first mistake that silently destroys most portfolios heading into 2030 is blind faith in traditional paper assets. For decades, investors were told that stocks and bonds are the safest, most reliable way to build wealth. And while that might have been true in the past, the financial landscape of the next decade won't reward the same old strategies. Think about this. From 1980 to 2020, the global economy was driven by one thing: expansion. Lower interest rates, predictable inflation, and endless liquidity made it easy for companies to grow, for investors to profit, and for governments to borrow. But that era is over. Inflation is no longer temporary, interest rates are no longer near zero, and the global debt pile has crossed $300 trillion. That means every dollar printed from now on has diminishing impact. The result? Paper assets like bonds, once considered the safe haven for retirees, are quietly becoming wealth traps. The 60-40 portfolio, 60% stocks, 40% bonds, which used to be the sacred formula for balance, lost more value in 2022 than in any year since the Great Depression. The reason is simple. When both inflation and interest rates rise simultaneously, both bonds and equities fall together. Most people don't realize that when inflation eats away at purchasing power, the nominal growth in their mutual funds or retirement plans doesn't reflect real growth. Earning 8% in the market means nothing if inflation silently steals 6% of it every year. In real terms, your portfolio barely crawls forward, while the cost of living sprints ahead. And this trend isn't slowing down. Artificial intelligence, deglobalization, and the energy transition are reshaping supply chains and pricing structures worldwide. These forces are inflationary by nature. So even though your mutual fund statements might look positive on paper, the real buying power of that money could be lower than it was a decade ago. Meanwhile, corporate earnings are becoming less predictable. Automation is replacing jobs faster than new industries can absorb them, creating consumption gaps. Companies with massive valuations today might struggle tomorrow when consumers pull back. The stock market indexes we've trusted for decades, the S&P 500, NASDAQ, and others, could no longer represent where true value lies. The real danger is psychological. People feel safe with paper assets because they can see their balance grow in numbers. But those numbers are just digital illusions, promises from institutions that rely on confidence to function. History has shown us that every time confidence collapses, paper wealth evaporates. The dot-com crash, the 2008 meltdown, the pandemic sell-offs, all were reminders that printed numbers don't equal real value. By 2030, experts predict that the world's largest economies will face cycles of monetary tightening and easing so frequently that the idea of long-term stability in paper assets might completely disappear. Central banks are trapped between two choices: print more to stimulate growth or tighten to control inflation. Either way, ordinary investors lose through devaluation or stagnation. But here's what the smart money is doing differently. The world's richest families, sovereign wealth funds, and top hedge managers are quietly reducing their exposure to traditional paper assets. They are shifting toward tangible, scarce, or productivity-linked assets that hold value beyond government control. They understand that when the system shakes, real wealth doesn't sit in brokerage accounts. It sits in assets that produce, store, or protect value. If you keep your portfolio overly concentrated in paper promises, corporate shares, government bonds, or fixed deposits, you're essentially betting on the system itself. And when the system weakens, so does your financial foundation. The painful truth is this: the era of passive investing is coming to an end. Simply holding index funds or saving through standard investment plans won't protect you in the decade ahead. You'll need strategic allocation into assets that can outperform inflation, hold intrinsic value, and remain useful regardless of economic cycles. As 2030 approaches, the investors who fail to recognize this shift will look at their safe assets and realize they've been standing still in a fast-moving world. The money will look the same, but buy half as much. The ones who thrive will be those who learn to convert digital promises into tangible power. By understanding which assets remain valuable even when the financial system doesn't. The second mistake that traps 90% of people heading into 2030 is underestimating the silent decay of fiat currency and overestimating their bank's protection. Most people believe that keeping money in savings accounts or fixed deposits is a sign of being financially responsible. It feels safe, predictable, and logical. But what they don't see is that while their account balance stays the same or even grows slightly, the real value of that money is shrinking every single year. The modern banking system wasn't designed to make you rich. It was designed to make you comfortable enough to stay dependent. When you deposit your money, banks use it to lend, invest, and multiply their profits, while paying you interest rates that barely touch inflation. Imagine this. You deposit $10,000 in your bank today. The average savings account gives you 4% interest. Inflation, in real terms, is around 6% globally. That means even though your statement will show $10,400 next year, your purchasing power will actually be closer to $9,800. You think you're earning, but you're quietly losing. This gap between what banks pay and what inflation takes is the hidden tax on savers. Governments love it because it allows them to inflate away their debt without directly taxing people. You keep your money in the system thinking it's safe, but you're unknowingly helping governments and financial institutions balance their books. And the danger gets worse as digitalization spreads. By 2030, cash will become almost obsolete in most developed economies. Central bank digital currencies, CBDCs, are being tested across the world, promising security and convenience. But what they actually introduce is control and surveillance. Your spending habits, savings patterns, and even financial priorities could be tracked, limited, or taxed in real time. In such a world, simply keeping your cash in the bank becomes a liability, not a safeguard. You don't truly own that money. You merely have access to it under rules set by someone else. If a major economic crisis, cyber attack, or currency reset occurs, something experts have been warning about for years, your digital balance could be frozen, limited, or devalued overnight. We've already seen hints of this. In 2013, depositors in Cyprus woke up to find their bank balances forcibly reduced under a bail-in measure to save the banks. In 2022, several countries imposed withdrawal limits to prevent currency outflow during inflation spikes. These weren't third-world cases. They were warnings of what's possible anywhere. The rich already know this. That's why they keep minimal liquidity in banks, only enough to manage short-term operations. The rest is stored in productive or non-correlated assets that don't depend on a bank's solvency. They diversify outside the traditional system into private credit, commodities, and real assets that aren't bound by government interest rate policies. Meanwhile, the average saver still believes that their 5-year fixed deposit is a safe investment. But by the time it matures, inflation has already eaten away the equivalent of 1 or 2 years' worth of returns. You may feel like your balance grew, but in purchasing power, you've gone backward. This illusion of safety is what traps 90% of people. The numbers look comforting, but the underlying reality is brutal. Fiat currency is no longer designed to store value. It's designed to circulate value. The more you hold it, the more it erodes. Now combine this with the growing government debt crisis. As nations borrow more to sustain their welfare systems, they rely heavily on creating new money. Each new dollar printed reduces the value of the existing ones in circulation. It's a cycle that has no end. and the cost is carried by the ordinary saver. By 2030, experts estimate that the global debt to GDP ratio could exceed 350%. That means your currency, the one you earn, save, and spend, will continue to lose strength against real assets. But there's a deeper layer most people ignore. Inflation doesn't hit every product equally. It hits essentials first: food, energy, housing, healthcare, the things you can't avoid. So while luxury goods or tech products might fluctuate in price, the things you need to survive will keep getting costlier. That means your bank balance, even if it looks stable, buys you less of what truly matters. The smart investors of the coming decade will adapt by doing the exact opposite of what the system teaches. They will hold minimal idle cash, convert depreciating currency into appreciating stores of value, and maintain liquidity only in assets that can be quickly redeployed, not locked away. Because when the financial system rebalances itself, and it will, those holding real, scarce, or self-sustaining assets will watch their purchasing power rise, while those holding digital numbers in their bank accounts will quietly fade into financial irrelevance. In short, the true risk is not volatility, it's the illusion of safety. The third mistake most people will regret by 2030 is overlooking the power of future-driven, productivity-linked assets. While traditional stocks, bonds, and cash might appear stable, the real wealth in the coming decade will belong to those who understand the underlying engines of value creation, the assets that produce, innovate, and solve tomorrow's problems. Think about it. The world is shifting faster than ever before. Artificial intelligence, renewable energy, biotechnology, and automation aren't just buzzwords. They are the pillars of the next economic expansion. Assets tied to these sectors don't just sit there. They actively generate value, growth, and opportunity. Meanwhile, most investors continue to rely on yesterday's winners, unaware that their relevance is fading. Take energy, for instance. Oil and gas stocks were once the crown jewels of portfolios. Today, governments are phasing out fossil fuel subsidies, EV adoption is accelerating, and major corporations are pivoting toward clean energy. A traditional energy stock that looked safe 10 years ago could now face declining demand and regulatory pressure. Holding it blindly is a recipe for stagnation, or even loss. Now consider lithium, cobalt, and other materials essential for batteries powering electric vehicles. The demand for these raw materials is projected to double or triple in the next decade. Investors who recognize the productive utility of these commodities, not just their speculative value, will ride exponential growth. This is why mining stocks, industrial metals ETFs, and green energy infrastructure are becoming the new frontiers of wealth preservation. Similarly, biotech is reshaping healthcare. Companies developing therapies for chronic diseases, longevity solutions, and gene editing are creating products that will be in demand regardless of economic cycles. Investing in these productivity-driven assets isn't just betting on profit. It's aligning with a tangible shift in human need, the kind of shift that guarantees enduring value. But most people avoid these sectors because they feel complex or risky. They see technological innovation and assume it's volatile. And yes, some of it is. But the key is identifying assets that have intrinsic utility, products or services that the world cannot function without, and staying patient for the long-term trend. This is where the top 10% of investors think differently. They don't just buy shares, they acquire pieces of the economy that create wealth on their own. Renewable energy plants, high-demand industrial metals, AI-powered automation firms, and essential biotech pipelines. These are assets that continue generating value regardless of short-term market swings. The mistake is psychological too. Most people measure success by immediate returns, quarterly profits, year-over-year stock prices, or how much cash sits in their accounts. But the real indicator of value is sustainability. By 2030, investors who prioritize productivity-linked assets will have portfolios that grow not because the market is lucky, but because the assets themselves create growth. Look at the historical pattern. The companies and assets that survived multiple decades of technological disruption, think IBM in its prime, General Electric at its height, did so not because of speculation, but because they were indispensable to the world's functioning. Fast forward to today, and the same principle applies. AI chips, cloud infrastructure, EV battery metals, and biotech platforms are indispensable. They are the productive backbone of the next financial era. Another hidden layer is that these assets often hedge against systemic risk. While paper money and traditional bonds lose value in inflationary periods, productive assets retain intrinsic worth. A factory producing lithium batteries, a biotech firm curing rare diseases, or an AI company powering essential operations, their value doesn't vanish when currencies weaken. It adapts, grows, and compounds in real terms. Yet the majority of investors continue to buy outdated advice. Invest in index funds, save cash, diversify broadly. Diversification is important, yes, but diversifying into assets that cannot produce real, lasting value is a false safety. By 2030, holding too many of these will feel like a missed opportunity, a portfolio full of idle numbers, while others' wealth multiplies in tangible ways. Even small investors can participate. They don't need to buy entire factories or control biotech patents. Investment vehicles such as sector-specific ETFs, mutual funds focused on AI, green energy, or healthcare innovation, and even fractional ownership platforms allow access to productivity-linked assets at minimal risk. What matters is aligning with future utility, not past reputation. The lesson is clear. As the next decade approaches, static wealth, money that simply sits, will lose relevance. Growth and protection will come from assets that produce, solve, and adapt. And those who ignore this will be left wondering why their safe investments never really worked, while others quietly built exponential wealth around them. The final mistake most people will make before 2030 is failing to diversify into alternative, non-traditional stores of value that act as both hedge and growth engine. By now, we've talked about traditional paper assets losing power, fiat currency silently eroding wealth, and productivity-linked assets driving future growth. But even after addressing all of that, a huge majority still overlook an essential layer: assets that are scarce, tangible, or culturally valuable. Things money cannot create out of thin air. Take collectibles, for instance. People often dismiss rare art, vintage cars, luxury watches, or first edition books as frivolous hobby purchases. But history tells a very different story. A 1955 Mercedes-Benz 300 SLR coupe sold for 135 million euros in 2022. A single painting by Leonardo da Vinci fetched $450 million in 2017. The point isn't just the price, it's that these assets grow in value regardless of inflation, currency fluctuations, or economic cycles. They are timeless repositories of wealth. Similarly, land and real estate are no longer just about residential homes or office spaces. Strategic real estate, whether it's land in high-demand urban areas, industrial warehouses, or specialized commercial properties, acts as both an inflation hedge and a wealth generator. While the masses debate savings interest rates, the top 10% quietly watch their properties appreciate steadily, generating rental income and long-term capital growth. Another overlooked category is intellectual property and digital scarcity. In the next decade, assets like patents, licensing rights, domain names, digital art, and even virtual real estate and metaverse platforms will have true scarcity and utility. Unlike money printed by governments, these assets cannot be duplicated at will, making them inherently valuable. Early adopters in these spaces will enjoy exponential returns, while the average investor remains confined to traditional markets. Then there's the role of safe haven currencies and sovereign guarantees, but with a modern twist. The Swiss franc, British pound, and carefully chosen government bonds will continue to play a role, not as primary growth drivers, but as stabilizers. By balancing these with tangible and productivity-linked assets, investors protect against systemic shocks while maintaining upside potential. The mistake most make is relying on these as core assets instead of using them strategically to complement other holdings. Even small investors can leverage these alternative assets without needing millions. Fractional ownership platforms allow shared investment in collectibles, high-end real estate, or intellectual property. ETFs and mutual funds focused on scarce commodities, industrial metals, or emerging technologies give exposure without requiring ownership of entire mines, factories, or patents. The key is not the amount of money you invest, but the type of value it represents. By 2030, the financial ecosystem will reward those who think beyond the conventional. The next decade won't just be about stocks or savings. It will be about understanding scarcity, utility, and adaptability. Those who fail to reposition their portfolios to include tangible, scarce, and productivity-driven assets will watch their peers multiply wealth while they remain trapped in obsolete strategies. The lesson is urgent and clear. The 2030 asset mistake isn't a sudden crash or market event. It's the slow erosion of value while most people continue to play by outdated rules. Cash, conventional bonds, and passive index funds will no longer protect or grow wealth the way they once did. Wealth creation in the next decade will be strategic, deliberate, and aligned with real intrinsic value. The time to act is now. Reassess your portfolio, identify the silent risks, and start shifting toward assets that not only hold value, but actively grow it. Because by the time the majority realizes their mistake, the gap between them and those who acted early will be enormous, and it may never be possible to close. So here's the truth. The 2030 asset mistake isn't obvious. It doesn't hit like a stock market crash or a sudden economic collapse. Instead, it sneaks up slowly, eroding your wealth while making you feel like you're playing it safe. Most people will wake up in 2030, look at their portfolios, and realize that their secure investments barely kept pace with inflation, while the world's real wealth creators surged ahead. The difference between losing and multiplying your wealth isn't luck. It's knowledge, timing, and action. It's understanding which assets will hold value, which will produce growth, and which will protect you when traditional systems fail. By diversifying smartly into tangible assets, productivity-driven sectors, scarce commodities, and modern safe havens, you are not gambling. You are positioning yourself for certainty in uncertainty. This is why waiting is the worst thing you can do. Every month that passes with your money sitting idle in banks or outdated investments is another month of invisible erosion. Every year you delay reallocation is another year your wealth lags behind those who are already adapting. So start today. Review your portfolio. Identify the areas where you're unknowingly exposed to this 2030 mistake. Take steps, even small ones, toward assets that appreciate, protect, and compound in real value. Gold, industrial commodities, selective real estate, innovative technologies, collectibles, and sovereign guaranteed instruments aren't just options. They are shields against the slow erosion of wealth. Remember, the clock is ticking. The investors who act now will thrive. Those who wait will wonder why the world's wealth shifted while they stayed in neutral. If you found this video useful, hit the like button. Subscribe for more insights that help you think ahead of the crowd, and share this with someone who still believes saving in the bank is enough. The sooner you act, the more secure and powerful your financial future will be.